We know that you want to invest in S&P 500 because they have not lost money in a single 20-year period since their existence. If that were not why you came here, at least now, that would get you excited to learn how to invest in index funds. It is the safest way to retire early. Let us get started. Number 5. Set goals. Dilly and Barrows, an investing expert, says, "I don't have time to be looking at financial statements all day long. I have to walk my dog. I have to take a vacation. That is why I like index funds. It's an all-in-one package. She keeps 85% of her assets in index funds and never worries about it."
85.
For instance, the index funds might reduce in value, but one may never lose money. Whatever the case, your initial amount will never fold, even in an unforeseen circumstance when negative returns are recorded. The S&P 500 has been in existence for many years. According to Measure of a Plan, a personal finance website, it has delivered negative returns in 31% of its history. However, one can count on the fact that there has not been a single 20-year period in which it has lost money. That explains why index funds for beginners are usually projected as a long-term project. If you are not in a hurry to see money in the next 20 years, put it in an index fund. Okay, 20 might be a little too much, so let us say 15 or even 5. The longer you wait, the heavier your stock gets. Ideally, this goes with age too. At 21, if you are making money off your YouTube, you can hold out until you are 36 to start seeing money. However, someone at 4 to 5 might only need 5 years. So the younger you are, the more aggressive you should be with holding out your index funds for long periods. Your goal should include how much of your money should go into keeping the investment. That is your expense ratio. Fidelity offers zero expense ratio, the best choice, although others are available. We will present more on it later. Number 4. Choose an index. To settle on an index, scan the market for those brokers who offer market indexes on all groups of investments. Suppose you encounter someone who gives ETF investing only, knowing that you might not be diversifying enough, despite the extent of diversity in the ETF structure. Primarily, companies like S&P 500 are the core stocks that these brokers offer. Alternatively, you might bump into those who track international stocks, such as MSCI Emerging Markets.
Boring.
If you are fortunate, your index might also track bonds and currencies. If you are a beginner, picking the most broad-based index fund that covers the entire stock market is an excellent place to start. You might get the index funds explained in Better Prospects for you in their total stock market. Number 3. Pick a fund. Fidelity and Ally Invest have zero expense ratios on their index funds. That is where you should be looking. Fidelity is the leading one with a zero expense ratio, but many others have no or low fees. According to Fidelity's president, Kathleen Murphy, they are rewriting the investing rules. Their $7 trillion, firms apply no expense ratio to education plans, 529, and mutual funds. When you find the right index, your next target is choosing out of the available fund options. All the funds that track a similar index might produce similar history. So the idea is to not focus too directly on the performance histories. Those might be confusing. Instead, the differences in fees could prove a significant gap. The amount you lose after each transaction, the broker's commission, and how often you pay it, the taxes involved are all called the expense ratio. Therefore, choose one with the lowest expense ratio. Finding the least expense ratio is not where the battle ends. Sure, you can go on vacations and walk your dog, but you need to spend some time each month to invest more. We will present more on your follow-up tips shortly. Number 2. Buy shares. Now we are down to the real money spending. So subscribe for free because we will teach you how to make money. Investing in an index fund simply means buying shares of that fund. There are 2 ways to invest in an index fund. First, you can buy through your tax-advantaged retirement accounts. Those slow down your headache to always calculate extra taxes off your investment. However, you can directly invest through a taxable brokerage account if this is new money. Moreover, some brokerage accounts require a minimum investment of thousands of dollars to start. So pick what suits you.
I already know.
Number 1. Follow up and invest more. Experts advise prioritizing your retirement accounts, but you can also invest monthly. Especially if you are looking at retiring early. Index funds give you the freedom to earn passively and require no daily devotion. Nevertheless, you should not forget about them altogether. Set up a calculator and identify how much you need to invest in your goal to attain financial independence in the shortest time. Are you wondering if the index funds scene is the right place for you? Or are you asking yourself about another fund? Like, what is ETF investing? We have a video guide on what commissions, transfer charges, and ownership costs make sense for a new investor between index funds and ETFs. Watch Index Funds versus ETF. Which one to choose and why?